Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod. I'm your host, Joe Mosier, and thank you, as always, for choosing to spend your time with us today. You know, several years ago, we all recall, in the wake of the Iowa derecho and a number of other catastrophic losses due to weather, the insurance market completely shifted for agribusiness. You might remember, personally or anecdotally, premiums spiked. Some agribusinesses were surprised with non-renewals. There's a number of companies, the companies willing to underwrite ag operations in rural areas completely contracted. And some of those large insurance firms that used to be reliable suppliers and providers of risk management solutions and products opted out of serving the ag market entirely. What we know now, here in 2025, is that hard market has started to moderate, and even in many places has completely moderated. Premiums that are collected now by the insurance companies are seemingly adequate to cover actual losses, and then sometimes far in excess of actual losses. And we're seeing some premiums even sometimes come down once in a while. There's more stability in agribusiness underwriting. Overall conditions are more favorable. That hard market has softened, but that doesn't mean that you shouldn't be paying attention to it. I increasingly read about and overhear and talk with companies that are opting into captive insurance structures. That companies are getting more sophisticated in analyzing their company's statement of asset values. They're thinking about their actual, okay, if that's our risk, what's our risk appetite? And then putting together better control frameworks and programs to actually manage the risk. And so with all these conversations going on with a shifting external marketplace of who's providing different kinds of solutions at different prices, the way companies are thinking about the underlying risks and how they're choosing to act, I thought, well, that would be a good topic for us to cover here on the podcast. And so to do that, I recently sat down with Lane Danielsen, who's the ag practice leader at TrueNorth Companies, and Jonathan Stark, TrueNorth's VP for Alternative Risk and an expert in insurance captives. We wanted to explore these ideas, provide an update, and maybe provide a little bit of an outlook of what to expect going forward. So in our discussion today, you're going to hear us get pretty technical on what a captive is, what a captive requires, and why more agribusinesses, especially co-ops, are looking at it as a vehicle for gaining better control, perhaps creating some underwriting income, and sometimes, in certain cases, even realizing some tax advantages from doing so. We also talk about what insurance companies are looking at when they're writing policies for companies in rural environments, which is where the majority of all of you operate. We'll talk about the market for ag-related insurance today. So what has happened in terms of provider contraction or expansion, rate activity, premium activity, what the trends are. And then we're also going to talk about what you can do within the four walls of your organization to create more favorable conditions for getting and earning better premiums and having more insurance options. Options are everything here. And so we're going to leave you some things you can actually do to help yourself out. A quick reminder, though, before today's episode, if you haven't done so already, now is a great time to subscribe to the podcast and ensure that you never miss any of the content and conversations that we publish here each week. Thank you, as always, for being a listener and for being a member of the Pacesetter Pod community. And with that, here's my conversation with Lane Danielsen and Jonathan Stark of TrueNorth Companies. Lane and Jonathan, thanks for taking some time today to join me on the Pacesetter Pod.
Absolutely. Thanks for having us.
Let's get into it today. So you guys both work for TrueNorth Companies, which we'll talk about. We'll talk about the firm here in a little bit. One of the reasons that I wanted to have you on the show was to talk to us not just about what's happening in insurance and insurance relative to ag, but to get in specifically to, I don't know if you call it a phenomenon or not, but this trend, this proliferation of captive insurance programs or captives for co-ops. I don't have any specific data to prove this. Maybe you guys do. But it feels anecdotally like it's a growth story, particularly relative to traditional insurance options. And more of the co-ops that we interact with and work with are either in captives or are talking about, is that a solution for them? But I don't want to assume that everybody understands these in detail, and I don't want to jump ahead too far. So maybe a good place for us to start today is, what is an insurance captive? And is this, in fact, an expanding marketplace or expanding product for the co-op space?
Yeah, no, this is Jonathan. I can take that. So, what is a captive insurance company? A captive is a closely held insurance company that is owned and controlled by the insureds. So, the key there is sometimes we like to say every insured is an owner, every owner is an insured. There are definitely some deviations from that with agency captives and specific types of captives. But essentially, if we use a co-op for an example and a single parent captive, the co-op would be the owner of the captive and the insured of the captive. And the captive would only be able to insure the co-op being the owner or the co-op's affiliates, or sometimes what we call controlled unaffiliated business. But primarily it's insuring the risk of the owners. And those owners are putting up capital that is at risk in the event of losses. So it's a formally regulated insurance company. I think that's another key point, that it's regulated by either a state or a country, and it's regulated by the insurance department, just like Geico would be. But it's different in that it's closely held and it's not selling insurance to the general public. It's just insuring the risk of the owners.
Am I correct on assuming that you could have multiple co-ops that may otherwise be competitors within a specific geography or maybe in adjacent geographies that are also co-owning a captive, or is it truly proprietary to one entity?
No, you're absolutely right. So there's what I was referring to as a single parent captives. There's also group captives where each of those co-ops in your example would be a member or owner, and each of them would participate in the insurance or purchase insurance from the group captive or some commercial carrier that sits in front of the group captive and reinsures the risk to the group.
Lane, why is this something that is attractive to co-ops, and why are we seeing co-ops choose to go this route? What's the value proposition of a co-op?
I think ultimately control over their insurance, control over the advantages of a captive is you can now insure your own risk. It's a form of self-insurance. So if it's single parent, we typically see larger cooperatives or larger risks that enter into that. A group captive allows a group of insureds to own their own insurance company and really take control of their insurance program. And, there's lots of advantages that Jonathan could speak to, but I think the reason for the popularity of them right now is the opportunity to get out of this hard and soft market. And so to be able to take control of your insurance spend, insulate yourselves from the broader insurance market. If you can control claims in your captive, and you're going to get better rates. And so typically captives are the better risks. The better risks are going into captives because Jonathan said, in order to get into a captive, you have to put up capital, and that capital is at risk. And so we talk to every insured, do you want to own the insurance company and take this risk on? And so we do that review, and because essentially, you're putting your money at risk. And if the captive performs worse than the market, now all of a sudden it's, you're in a worse spot, and you're essentially could be losing money in that self-insurance model.
I think there's a couple of things. So one is from an underwriting income perspective. So co-ops have been paying premium to a third-party insurance company for a number of years, and they may look at their premiums over the last 5 years and say, okay, we paid $15 million to the market and we had $5 million in claims, right? Just to use a simple example. Their next question to their broker is, well, the insurance company's made $10 million off us. That doesn't make a lot of sense. Why are we paying $15 million in premium? And there's several answers to that. One answer is you have a lot of catastrophic exposure. So you may not have had a very large loss, but you could have the potential to have $100 million loss. So obviously the carriers have to charge much more than your sort of typical loss year. But I think when a manager looks at that type of underwriting income that's leaving or that's going to a carrier, they think there has to be a better way to do this. And one way to do that is to increase the amount of risk you're taking So by increasing the amount of risk you're taking, by changing your deductible from $10,000 to $1 million, the carrier is going to give you a premium credit. So they're going to reduce your premium to take on additional risk. The question is, are your losses in that layer better than the premium that you're getting back? Or are they lower than the premium you're getting back? And from a very simplistic standpoint, that's the calculus that's going on when you look at a captive. If we took our deductible up to $1 million and we got $500,000 back on our premium to do that, are our average losses in that new deductible layer less than $500,000? And if that's the case, let's pay that $500,000 to ourselves. So we're still going to pay that to ourselves. We're still going to fund that. It's still going to show an expense on our P&L. But now if we perform well, we're going to get that back.
Mm-hmm.
So underwriting income is the most sort of typical reason that people come into captives. That's the big one, number one. Number two, to Lane's point, is control. And they kind of go hand in hand. So if you're taking more risk, if you're now taking $1 million per claim on property, $250,000 per claim on workers' comp or general liability, you're not putting losses on the carrier's balance sheet every year. In fact, in most years, they're not going to pay any losses at all because you probably won't have a loss greater than $250,000 for workers' comp, greater than $250,000 for general liability, or greater than $1 million for property. So they don't have as much justification to increase your rates each year because you're paying your losses. They're only taking the catastrophic exposure. They're only taking the $1 million pop. So that adds control. It also allows more carriers to compete on your business. So a lot of carriers may not be willing to underwrite your risk at a $10,000 deductible because there's a lot of frequency in that layer and they're not so sure about your controls, how you manage risk. But if you're willing to take the first $250,000, it does two things. It gives the carrier an ability to feel more comfortable further away from the frequency. And it also shows that you have skin in the game and that if you're taking the first $250,000 on casualty and $1 million on property, then you're obviously willing to take that risk. The assumption there is that you're doing things to control that risk, right? So I think that's how to get more control over your insurance program through a captive. Is higher attachment points mean more carriers are willing to write, means you have more competition, which means they can't jack up your rates. And also you're taking a lot of the claims off the balance sheet of the carrier. I think the third piece is there are financial and tax benefits associated with captives in certain instances when compared to self-insurance. So let's say you had a $250,000 deductible for workers' comp and you were self-insured. If you didn't have a captive insurance company, you cannot deduct any of the funding associated with that $250,000 each year until a loss is paid. Meaning you don't take a tax deduction until you actually cut a check to pay a claim. With a captive insurance company, and there's a big caveat here, assuming it qualifies as an insurance company for tax purposes, you deduct the funding paid to the captive as if it's a premium payment to a third-party carrier. The captive is then able to hold reserves against that premium called IBNR reserves, which are an estimate of future losses. So that income is shielded. And then over time, either those reserves turn into paid claims or the reserves come down and they're amortized into income. So it results in a deferral, a tax deferral or a tax benefit when compared to self-insurance. So those are kind of just in summary, the three big things are control, access to underwriting income, and then the sort of tax benefits. I will give a fourth, not to get long-winded here, but there is some formality. You'll talk to a lot of GMs and they'll say, oh, well, my premium's only $1 million. I got this great deal. And you say, yeah, well, what are your deductibles? Oh, I increased my deductible from $50,000 to $1 million on property and from $10,000 to $500,000 on workers' comp. It's like, well, do you really have a better deal? You're paying $1 million in premium. You used to pay $2 million, but did you quantify the risk inside those deductibles? Did you get an actuarial report? Because if you haven't had great performance, your total cost of risk, meaning the amount of claims you pay in your deductible plus your commercial premium, could actually be higher. So I think the captive adds formality and it really helps you make a good decision around whether or not you should be taking on more risk, or if you're kind of, the tail's wagging the dog and you're just trying to get cheap premium.
No, that's helpful, Jonathan. Thank you for that. And one of the things you mentioned there that I don't want to get buried, because it's something I think we need to talk about here in a few minutes, is inviting competition, to underwrite your business and underwrite that risk. Because we have seen a contraction in the number of folks that are going to write policies against agribusiness related risk. And so I think anything you can do to invite competition by having the profile of a disciplined operator who's got some good controls in place, who's willing to take some risk on the back of those controls, is going to just simply, it expands the network or the pool of people that you could potentially partner with for your insurance purposes.
I was just going to say real quick, Joe, Lane's has intimate knowledge sort of how the marketplace has changed over the last 5 years and really has some good context around that when you're ready.
Yeah, for sure. Before we get to that, because I want to talk about some of the nature, the risk factors of operating in rural environments that are true for ag and non-ag businesses. We'll talk about ag specifically, but let's take a moment and talk about TrueNorth Companies. So you both work for TrueNorth. Maybe give us the 101 lane on who TrueNorth is. Where do you play specifically in the ag space? And then maybe a quick summary of the roles that you each hold in the organization.
You bet, Joe. So I am the practice leader of our ag team at TrueNorth. And so I lead all things commercial ag. And who TrueNorth is, we're a top 50 broker. We're headquartered in Cedar Rapids, Iowa. We have offices throughout the Midwest, Chicago, Des Moines, and Denver are regional locations for us. We have employees throughout the country. And so we're really different, is we're kind of a boutique, problem-solving, industry-focused brokerage. There's 36,000 insurance agencies in the United States, and we're in the top 50. If you look at true privately held independent, we're probably in the top 10. And so private equity and publicly traded companies have been acquiring a lot of our competitors over the last, particularly since COVID, the last 4 or 5 years. And it's becoming more and more challenging to remain independent and privately held. And we have a leadership team at TrueNorth that has ownership across the board. And we are fiercely independent, as we say. And why that matters for commercial ag is our constant focus on client experience and solving problems. And we, in order to remain independent and privately held, we're going to grow. We're going to grow by taking care of our current clients and constantly solving problems for our clients. And so we're not going to go up against Marsh and Aon and beat them because we're bigger and we have more premium in the market. We're going to beat them because we're nimble and we're focused on our clients in the industries, and we're investing in everything from local associations to investing in solving problems like captive studies and hiring people and looking at technology platforms. Where we're really different is the risk financing, where Jonathan, the ability to do a study in-house and then actually build it and then actually carry it out. And then if we're going to move our clients to some type of self-insured model, whether it's a group captive or a single parent or just full-blown self-insurance, we better be coming alongside you, helping you manage your claims, helping you control your claims, whether it's people or technology or it's anything. We want to be that boutique, and our mission statement is to protect and maximize. If we're just bringing our clients, self-insured or group captive solutions, but we're also not providing the resources to control claims, then we're doing them a disservice.
That's helpful. Thank you for that. So panning back, let's talk about the context in which you're solving these problems. And you're coming alongside your clients as they manage claims, and you're helping them think about how do they maximize the resources available to them as they grow. Agribusinesses writ large They don't all sit in West Des Moines. They don't all sit in the Twin Cities. They don't sit in St. Louis or Chicago. They're in rural parts of the United States. So let's talk about the conditions that they operate, those rural conditions. So aside from ag operations specifically, what are some of the unique risk factors that you see impacting both the willingness of folks to underwrite policies for these businesses, as well as the things that might change the actual risk profile of businesses in rural environments?
Well, there's really two sides of the house. On the property side, Joe, commercial ag continues to grow. And so the property structures that the commercial ag businesses are putting up continue to grow in size and scope and insured value. So the other thing that's creating challenges is we continue to have catastrophic weather events that challenge that. And so the rural ag aspect, number one, it's typically farther away from really good fire departments. It's high value, oftentimes combustible structures, whether it's a dry fertilizer building that's wood frame, or it's a poultry or a swine confinement that is wood frame, that if we have a fire, there's no partial loss in that instance. It's going to be a total loss. And so we need, as these total insured values and ag companies merge and get bigger, 6-7 years ago, it was pretty rare for a cooperative to have $1 billion of property. Today, it's more and more common for a cooperative to have $1 billion of property assets. And so we need really strong financial insurance companies that can pay a claim and stand in there and being able to withstand it, renew it, stick with them. And that led us to 8 days ago, had the 5-year anniversary of the derecho that hit the Midwest, the largest single loss in Midwest history from a property standpoint. And so there's less and less domestic carriers with the financial strength and the want to insure the risks in commercial ag. And
just to add one thing there, Lane, I think the other piece on a couple other points on the property, I think number one, just the grain bins and the way they're built and whether or not they're full of grain could make them a really easy target for a wind event. So empty grain bins crunch like a Coke can, and those can become quite expensive to put back up. So I think the catastrophic weather and the wind events and the derecho showed that the commercial ag structures in the Midwest are susceptible to wind damage and can create very significant losses. The other thing is post-COVID, with the supply chain issues, there is significant inflation in the cost to rebuild those structures. So all of a sudden, you may have not built that many new structures, but the cost of steel or the cost to rebuild has led to your total insured values increasing 15, 20%. So all of a sudden, you're insuring much more total value. Therefore, you're paying much more premium. Therefore, the carriers have to make a much more expensive claim payment to rebuild that same structure. Also, you have the inflation on, you have the normal volatility on the actual stock itself. But I think a big part of what led to that hard market was the very big claim, which showed reinsurers that there is an ability for very large catastrophic claims in this part of the country that could lead to single events exceeding the full reinsurance tower and hitting the high reinsurers. So that increases reinsurance rates, which trickles down into the domestic rates, which the co-ops pay. Also, the inflation on the statement of values has led to carriers doing all sorts of different things to decrease the amount they would pay in a claim today versus when that storm occurred. So when that storm occurred, a lot of structures were on replacement cost, meaning whatever it costs to replace the structure, in today's dollars. Whereas now they're moving to different methodologies to cap claim payments on certain structures. So they may cap it using stated amount, or they may cap it with a certain amount or actual cash value. There's different methodologies that carriers use to try to reduce the amount that they would pay out on a property claim. Sort of that single event got reinsurers scared that, okay, there could be $100, $200 million claims in this area. And then we have the inflation that led to the increase in values. And then the other thing is, I think the co-ops honestly have been flying under the radar for quite some time. Their rates did not make sense relative to what others were paying in sort of these large manufacturing, other industries that had really big asset schedules. They had very low deductibles and very low rates compared to some of those other industries. So they were kind of behind the times. And when that storm came, the market really caught up in one fell swoop. They said, we're doubling rates, we're doubling deductibles, and we're taking down the amount that we would pay in a claim.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
So I think that's an interesting point. We talked about this maybe about a year ago on the podcast where the relative attractiveness of an unchanged premium level year over year at renewal is it depends on over what time frame you look at it. So in the short term, it looks really positive because it's going to control your budget expenses into the next year. You controlled costs. That's great. Lowers the threshold for delivering a return to your producer owners and customers, or your customers, whatever, or your owners, et cetera. But over a longer term view, if you're looking at multiple year on year renewals with little to no change in your premium structure, meanwhile, your inventory is more valuable to replace, your assets more expensive to maintain, expansion of your plant is more expensive to build, you should start to see the daylight between what your insurance, your policy writer is saying the business is worth and what it actually is. And the more daylight's there actually spells you could have someone that's asleep at the wheel long term. So you talked about the cost being under the radar, but I think that's an interesting thing. And this is kind of a call out to everybody right now. If you look at even your home insurance premiums at renewal, look at the total replacement cost of your home, and then figure out what's the dollars per square foot to build new construction in your area, and figure out if a fire loss, that's a total loss, what's going to happen in the event of full replacement. Now, some places are going to have triggers where it's total insured value times 50, plus 50%, whatever, but that's that people might look and say, wow, this insurance premium that hasn't changed for a long time actually is a risk for us. And we want to call our broker and say, we're interested in paying a little bit more. We need to raise the value of this asset. So the other thing I'm hearing is there are some things that I'm guessing an Amazon distribution center built 50 miles outside of the closest MSA that may or may not be on municipal water. Maybe they probably have a fire suppression system on a well or something like that. But are they also going to be experiencing some of these higher premiums and higher risk profiles because they're also in the same environments where these derecho events and other things can happen? Again, I guess my question is this only ag, or is this everything that's in those rural environments?
No, the property market was hard across the board for all properties. Obviously, that whether or not it's specific to ag, I think you still have the same risk factors. There are certain things around the construction of certain ag assets, like grain bins, that may make them more susceptible to damage. But to answer your question directly, I think they have the same issues.
But in Amazon, back to our taking control, when deductibles are low and you're just exchanging dollars with the insurance company is going to win long term. And in Amazon's case, they can afford to take a significant self-insured layer. So then the only thing that they're transferring to the commercial market is the significant catastrophic. And they have a spread of risk. So that's the other thing that insurance does. It's risk pooling, right? So now they've got a spread of good and bad. They've got some warehouses that are in great locations and some that are in poor. And they've got critical mass, and they're willing to take a big deductible.
And I think the fundamental, to Lane's point, is a really good point. The fundamental thing you have to understand when you have low deductibles is your premium that you pay to a carrier is your expected loss plus a profit margin to a carrier plus their expenses to operate. And then they may reduce it slightly for investment income, right? So you are always paying a margin and expenses and giving away access to your funds for them to make investment income on. So if you have the capability to take a retention, you should, unless you want to, A, completely eliminate any volatility. Like you are just simply not willing to take on any volatility, or you don't have the cash to be able to take a very large claim or multiple large claims in a year at that deductible. But if you want control, you have to take more risk, because or else you're just going to pay an expense load and a margin and you're going to give them access to your funds. And that's really the fundamental of why you form a captive.
Joe, we say in every major metropolitan, the tallest buildings are insurance companies. They're really good at exchanging dollars with you. And in the long run, they're going to win. We had the derecho, and there was some clients that they had some major claims. And in the long run, over the spread, all those carriers are going to win. And if they don't win, they're going to do what some of the carriers have done, and that's leave the business. And then you have certain industries. Now, the co-ops were down to, 3-ish, maybe 4 carriers that can write a co-op in the US. There's other agricultural industries where there's 1 or 2, and it's London and a domestic carrier, or it's London only.
That perfect segue. You're reading my mind, Lane. My read is that wave of non-renewals, that reaction to the significant losses that were incurred, that I think you said earlier, Jonathan, that actually went to the high end of the reinsurance stack. So it kind of flowed all the way through the system. Everyone had a bit of pain. That seems to have largely passed. And we're seeing less volatility. I'm hearing less volatility from our customers as relates to year-on-year insurance expenses. They generally are now seeing it go up, or maybe if it stays flat, there's usually a story around why that is. So that the hardening on commercial operations has subsided. But let's talk a little bit more. Kind of walk us through that picture of the narrow distribution of the number of people who actually are participating in this market, Lane, and where you see that going. Do you see further contraction to the extent that it's possible? Or do you think over time, more insurers are going to come back and to compete for that business?
The hard market, soft market cycle has been going on in insurance for 100 years. And so sometimes if you look at over the last 40, 50 years of insurance companies that have come in and out of the grain elevator co-op insurance business, when the market's soft and folks are making money, there's a lot of big insurance companies that are for profit that might turn to the co-ops and say, you know what, let's try that. And over time, there's been a handful that have really been there year in and year out, decade after decade. And, so I think that there might be, Joe, I think without getting too much into it, we have created a carrier. We've created a group captive for the co-ops. And that is competition. And competition's good. And the market is subsiding. And we are seeing some flat, a little bit of, for really good performing cooperatives, we're seeing a little bit of decrease or marginal increase. There is somewhat of a new normal. The carriers have increased their deductibles. They've increased their rates. Now there's a level of profitability in the industry that the carriers are like, okay, we're and the insureds are also, okay, yes, this is a new normal. It's still a lot more than we were 6 years ago. But there is that new normal that's leveled off some. And now that there's some profitability, who knows? There might be another carrier out there that says, you know what? We're going to get in this space because it looks attractive. Because it is attractive from a premium standpoint. The co-ops are big insurance premium dollars, spenders. Like there is, if someone wanted to grow quickly and they wanted to write 10 co-ops, they could take on a lot of premium in a heartbeat. But I would caution that, right? I would caution the co-ops to choose their partner, because any one co-op or large commercial ag risk out there could have a $50 million loss at any one day. And they need to choose their partner for someone that has the financial stability and strength and is not going to leave them if they do send them that claim.
Yeah, and I think to Lane's point and to your point, Joe, around the market softening a little bit, we've definitely seen the rates have increased so much, the deductibles have increased so much, and the valuations have decreased. So what I mean by that is that with the higher deductible and the carriers paying less out in the event of a claim, the coverage has shrunken quite a bit, but you're paying double or triple the rate for that coverage. So yes, premiums have leveled off, but that's after all of those mechanisms were used to right size it. So I think we're in a period where the co-ops have accepted the fact that I have to have $1 million deduct. If you're a decent sized co-op, I have to have $1 million deductible or else my premium's going to be crazy. And my rates have increased significantly, but I need that deductible to manage my spend. And I don't think every co-op has fully digested what they're going to get in the event of a claim, nor have they maybe done the necessary work on their statement of values to sort of strategically look at each location and what are we really getting in the event of a claim? Like what type of methodology do we want to use on the valuation of this particular site? And how do we want to go about insuring it? Because I think there's a lot of work that should be done, detailed work around your statement of values, what you're insuring, how you're insuring it to really maximize that insurance. But with, carrier in 2024, the carriers made money on the property side and London made money on the property side. So as a result, they have short memories. The reinsurance rates go down. The rates flatten off a little bit. London's probably offering some discounts to some really good risks to try to get market share. And then all of a sudden you have big claims again and it starts all over. Is really what you kind of see over and over and over again. And it also depends on interest rates. If interest rates are really high and you're getting high rates on your risk-free money, then maybe people are less willing to invest in an insurance company to make money. So there's all sorts of things that go into it, but I definitely think there's a new normal in the property world, big deductibles, higher rates. It has leveled off a bit. So I think if you've accepted where you are today, maybe there's a little bit less pain, but I definitely agree. There's 3 to 4 carriers that are kind of willing to write it. Outside of that, it's a bit of a challenge.
So one of the things I'm hearing here as we get close to the end for today is the through line that I'm picking up on is that listeners, whether they are agribusiness GMs or executives, owners or senior leaders of privately held, closely held, seed companies or FERT companies, grain companies, et cetera, when it comes to the risk and underwriting and the insurance of their business, things like compiling, analyzing, getting an opinion on your statement of values, that requires some thoughtful planning, some focus, and some rigor. Getting sophisticated in thinking about the risks you have in your organization and how you're controlling those risks. Because, a captive sounds like a pretty sophisticated product, a pretty sophisticated solution. And it's going to require you to be able to demonstrate and be able to authentically look at your board and say, this is the right path for us because, yes, we're absorbing more risk, but we've got the control environment and the processes and the people and skills and culture behind it to make that risk bet favorable to us. And then also just thinking about your underlying risk appetite itself. That's a couple things I picked up on, but as we get towards the end here, guys, let's put ourselves in the shoes of this co-op GM. They're listening to this. They're sort of digesting all the learnings and the facts and the verbiage that we threw at them and the terms. And they're thinking, well, what do I need to do? What's maybe the top 2 to 3 short list item that you guys each have that you would encourage our listeners to walk away with and consider doing today? And Lane, I'll let you start.
I would say, what we do at TrueNorth, Joe, is really educate our clients on their total cost of risk. Here, some folks call it T-Core. So what Jonathan and I do is your premium to the market is one aspect of your total cost of risk. The deductibles that you take, whether you want to or the market has forced you to take, that risk underneath that deductible is part of your total cost of risk. Because if you have a $1 million deductible or a $500,000 deductible, that is per occurrence. And you could have 5 claims in 1 year that are underneath that deductible, and those could equal $400,000 a piece. That is part of your total cost of risk. So I think where we're really unique is doing the underwriting analysis of the risk underneath your deductibles, and then truly understanding what you're going to get in the event of a claim, particularly around property. And looking at, the harder part of our market today, Joe, is the umbrellas, and looking at the catastrophic liability that the co-op is taking on, whether it's through propane or agronomy or, risks outside or the auto risks, and contemplating, what's the right amount of umbrella to take. And that is today probably the toughest piece. Insurance companies are losing money in the umbrella right now because of things like third-party litigation funding. Plaintiffs' attorneys are figuring out that co-ops have pretty good balance sheets with good insurance, and so they're targeting that. So I think just having this proactive partner, number one, and really understanding their total cost of risk versus just what's their insurance premium spend.
Yeah, and I think what they're paying their broker is a part of that as well. So what you're paying your broker, your commercial premium, and the risk underneath your deductible are all parts of your total cost of risk that could be attacked and reduced through some type of strategy. But I totally agree. You have to understand your total cost of risk when you're contemplating a captive and you're comparing it to other options in the marketplace. It can't just be how much you pay in premium, because oftentimes co-ops self-fund a lot of misapplication claims, or they pay their own physical damage claims. Or are you really considering how much you're paying for insurance across the board? I think the other piece of that is on the auto side. Auto liability is performing so poorly right now across, industry, across the insurance industry, and really trying to get caught up on what transportation companies are doing for wheels exposure, for companies that have large trucking operations, really understanding what people are using telematics, outward and inward facing cameras for, and how that impacts underwriting. Super important. But absolutely the umbrella, and that ties directly to the increased cost in the umbrella side. So the umbrellas are going up because of nuclear verdicts on the auto liability side primarily, or propane related claims for some of these ag companies. So your broker cannot just be a transactional guy that shows up once a year and gives you a premium. They really need to be a consultant that is helping you consider risk management changes, looking at your total cost of risk, advising you on how you should go about financing your risk. If you have large deductibles, do you want to be accruing for some of those losses on your income statement? You really need to have more of a consultant than just a transactional broker. And at TrueNorth, we think we have that.
Wonderful. Well, I think that is a fantastic place to leave it. Guys, I appreciate you taking some time to join us today.
Thank you.
And to our listeners, thank you as always for tuning in to today's episode. We will make sure that we have links to both Lane and Jonathan's LinkedIn profiles within the show notes, ways you can get in touch with TrueNorth and continue the conversation. And I hope that as you think about this episode, you found something not just of interest, but of actionable value, which I'm sure you did. And assuming you did, please consider doing this one thing. Share this episode with one of your peers in another organization, maybe somebody within your own company, someone in our industry that you think would find similar benefit. It's the very best way you can support the show and the work that we do here, and also help us in our strategy and our vision of helping elevate thinking around strategy execution all along the ag supply chain. Execution requires you to take on risk, and managing risk is how you get to good execution. So thanks again for joining, and I look forward to having you here right next time on the Pacesetter Pod.
This is the podcastfactory.com.